Welcome to the Accountancy Learning AAT sample paper walkthroughs. In this video, I'll take you through the Level 3 Financial Accounting Sample Paper 2 Task 4 about producing financial statements for sole traders and partnerships. So starting with Part A then, we need to identify whether the following statements are true or false. In a partnership, the current account shows the long-term investment in the partnership. So we're talking about the current account here. And we're talking about a long-term investment. So that's actually the capital. That's the capital that's been invested by the partners, which would be shown in the capital account. So that is false. The financed by section of a partnership statement of financial position includes the balances of the partner's capital accounts and current accounts. So this is true. That is what will appear in the financed by section. In partnership final accounts, the appropriation account starts with the gross profit figure. Again, let's look at the question. It's talking about the gross profit. So that's false, as it will start with the net profit. In a partner's current account, interest on capital is debited and interest on drawings is credited. So this is false because the current account is the business point of view. So it means that the interest on capital is owed to the partner by the business, so it's a liability. So that's going to be your credit. And interest on drawings is owed from the partner to the business, so that would be the debit. Identify which one of the following describes net assets, and we're given 4 options to choose from. So net assets then is going to be our total assets, adding up all of our assets that we've got, and we take off all of our liabilities. So total assets less total liabilities. Now we need to complete the following statement. The purpose of the statement of financial position is to, and then we've got 4 options. So just running through the options. Ensure that debits equals credits. Well, that's the job of the trial balance. Examine the cash position of the organisation. That's actually going to be part of cash flow. Show the assets, liabilities and equity of the business at a point in time. So that is about the position of the business. So that is the statement of financial position. And then show business performance over a period of time, just to complete the list, would actually be the statement of profit or loss. So that's how well has a business performed. Have they made a profit or have they made a loss? Lucy runs a jewellery and gift shop. She is a sole trader and her accounting year end is the 31st of March 20x8. The business is registered for VAT. The profit for the year has been calculated as £33,054. During the year, Lucy spent £180, including VAT at 20%, on personal calls. These have been included as a business expense in the accounts. So we need to complete the journal to correct that error. So it shouldn't have been put through as a business expense. Now with this one, we've got VAT to think about. So let's have a look at how the expense will have been put in. So we are going to have had a VAT account, the mobile expenses account, and then we would have had, it would have either been cash book or bank. We'll use the bank, or it might have been on credit as well, but probably more likely bank. So what would have happened is the full 180 will have come out the bank, and then we would have had 150 debit to our mobile expenses and £30 debit to our VAT. Now that shouldn't be in there like that. It should actually be showing in drawings. So what we're going to then do is we're going to put the full 180 into drawings, because as a personal expense, she wouldn't be able to claim back any VAT or anything like that. So she'll take the full cost of the 180 in drawings, and then we need to reverse out what's happened for the VAT and the mobile expenses. So she can no longer reclaim the VAT from HMRC, so that becomes a credit. And we're reducing the mobile expenses by the net amount, which is the credit of 150. So we now need to calculate the revised profit for the year after completion of the adjustment that we've just done. So we had 150 that's been taken out as our expenses in the original profit figure. So we need to take the original figure, and then we're going to add back in the 150 for those mobile expenses, those personal calls. That gives us £33,204 as the revised profit. Dylan runs a shop selling gardening supplies. He's a sole trader and the year end is the 31st of March at X8. VAT can be ignored. You're now working on Dylan's accounts. And then we've got a list of different transactions there, and we're asked to complete Dylan's capital account for the year. So just bear in mind here that he is a sole trader. So sole traders only have a capital account. In partnerships, you have a capital account and a current account, but sole traders, you only have a capital account. So the balance for the year is already in the table for us. So the profit, so when the business has made a profit, it means that that the business is going to owe that to the owner. So that's going to be a liability of the business. So it's going to be on the credit side. And it was £33,054. Dylan took drawings from the business. So that's going to be the opposite of capital. So we're in his capital account. We're going to decrease the capital. So that's going to go on the debit side of 28,956. We've got Dylan transferred his personal computer into the business where the market value was 1,250. So he's put personal computer into the business. That's a form of capital. It's a form of investment. So we can choose capital introduced of 1,250. And this would be auto summing in the exam. So we've got a higher debit side to credit side of 58,884. So we are going to want to balance that off. So our balancing figure then will be balance carried down of 29,928. Moving on a little bit further then, so we're given an extract of Dylan's trial balance for the year end 31st of March X8. And we're asked to complete the extract of the statement of financial position using those figures in the TB. And it tells us we don't need to complete the capital section of the statement. So let's have a look at what we are going to be using. So we are doing the statement of financial position, and we're going to be looking at the non-current assets to start with. So we've got the cost in there already. We need to find out the accumulated depreciation and then the carrying amount. So here we've got accumulated depreciation, 4,255. And when you find the difference between the cost and the accumulated depreciation, you get a carrying amount of 3,482. Now we need to look at our current assets. So for the current assets, we are going to be looking at accrued income. We're going to be looking at the bank, our closing inventory, and our receivables ledger control account. They are going to be the assets, the current assets that we need to put into the statement of financial position. So closing inventory, $11,424. We've got the receivables ledger control account, 12,361. The bank, 35,042. And then finally, accrued income is 2,081. And then in the exam, this will have auto summed to 60,908. Now we need to look at our current liabilities. So what will be our current liabilities in here then? So depreciation and disposals of a non-current asset, that's going to be part of your profit or loss. Your other expenses is part of profit or loss, and so too is the opening inventory as part of cost of sales. So we've then got the payables ledger control account as a liability for the statement of financial position. Then your purchases, salaries and sales revenue is all part of your statement of profit or loss. And then we're left with VAT as the liability as well. So we've got VAT of 3,648 and payables ledger control account of 30,814. And again, this will have auto summed in the exam, 34,462. So now we need to work out what our net current assets is. So we're going to take the current assets and we're going to take off the current liabilities. So that's just our net current assets of 26,446. But then to get our net assets, we need to add on our non-current assets. So make sure you know the difference between what your net current assets is and what the net assets figure is. So you then add on your non-current assets to give 29,928. That brings us to the end of task 4.